Hi everyone. Sorry not to be there in person, but I'm very excited to discuss this super interesting paper, so let's jump right in. The question the authors are asking in this paper is, what role did the big changes in mortgage technology in the 1990s play in the subsequent housing boom? The approach is a careful empirical exercise that exploits the differences in both the timing of the adoption of automated underwriting as well as the different standards across the competing products. The main findings are very large effects of these statistically informed underwriting rules on lending and house prices that in particular explain the majority of the rise in house prices over this period. So for a roadmap of this discussion, I'm going to briefly evaluate the paper and give some small suggestions. I'll discuss whether I find the estimates plausible. And finally, I'll try to pull out some broader lessons for macroprudential policy. So first, let's take a step back and think about what's new here, because this is not the first paper to think about automated underwriting systems being introduced. So Foote, Lowenstein, and Willen also exploit the timing of the adoption of these systems, but actually, while they find a big effect on lending, they find a very small role for these systems in driving house prices, in sharp contrast to this paper. Now, in this past work, a treated region would be one that had a larger share of early adopter lenders, and as the authors of this paper are aware, there could actually be a number of reasons why house prices in these regions evolve differently from control regions. So for one thing, you could have the change in credit standards that we're interested in, right? But in addition to this direct effect, there could be auxiliary effects driving house prices. First of all, there could be an effect just from automation itself. So even holding credit standards fixed, having an automated or streamlined mortgage issuance process could affect credit supply and house prices. But more importantly, I think, there could be selection effects, right? So selection into early adoption is not random, and this could be biasing results in a number of ways. So this paper, to deal with this, does something very clever by comparing two types of lenders who both adopt early. Lenders who sell to Freddie Mac and select into the loan prospector product are selecting into automation and changing their credit standards, while lenders who sell to Fannie Mae and select into the desktop underwriter product select into automation but don't change their credit standards. So both types of lenders are getting the streamlining benefits of automation, and they're both endogenously choosing to adopt early, but only the Freddie Mac lenders are receiving the change in credit standards, so the difference between the two should isolate what the authors are finding is a large effect of credit standards on house prices. My first suggestion is I think this is great. If possible, I think it would be nice to show directly that this is actually what's driving your results, and in particular that if you went back and pooled all early adopters together, which is pooling these mechanisms together, you would actually recover the Foote et al. Results. If you do, I think this is super convincing that this is a great method for dealing with this identification problem. In terms of my overall evaluation, I find the results very compelling. As I said, this is a really clever solution to this issue, using some institutional details I'd never heard of before. And another nice feature of the paper is it's almost all based on HMDA data, which is the universe of loans. You don't have to worry that these high LTI loans are actually being pulled from other sources outside the sample. There are a few remaining identification concerns, but I think this is likely unavoidable, and the authors have basically done the best they can. The two that come to mind for me is that the initial assignment to Fannie Mae or Freddie Mac is non-random. Freddie Mac historically specialized in thrifts, for example, so the business model may be different. And also, a bit more troublingly, the incentives to adopt the technology are a bit different if you're going to be adopting the loan prospector technology that changes your credit standards versus desktop underwriter, which does not. So one optional suggestion to address this is I think the authors could potentially try to instrument for early adoption of loan prospector with early adoption of any technology interacted with the Freddie Mac share. Now, the authors do show that the Freddie Mac share is the most important determinant of which technology you choose, but I think it would be really nice to use it as a first stage in an IV, which would formally get rid of some of these concerns. Now, turning to the estimates, right, they're very big. How did just switching from manual to automated underwriting explain so much of the rise in house prices over this period? Well, actually, I think this is quite plausible, right? And the reason is that the change in credit standards, which sensibly seems to have come from the introduction of these systems, is just massive, right? So mostly in terms of the limit on payment to income ratios. So if you look at these plots, which come from Fannie Mae data, very similar to the type of loans the authors are looking at, the right side shows payment to income ratios during the bust, right? I'd love to show in the 1990s where the authors are thinking about, but I don't have that data. So we're going to use the bust instead. And this shows what it looks like when lenders are actually putting a limit on payment to income ratios. Here they put a limit of 45, and you see basically no mass after that point. In contrast, during the boom period, where there was just automated underwriting systems that the authors are writing about, you see what I think is a very wild pattern, which is a completely smooth distribution of these payments income ratios all the way up to 65% of borrowers' pre-tax income being pledged toward their debt payments, at which point Fannie Mae is top-coding the data. There may even be observations passed here. So this shows basically extremely lax underwriting in terms of payments income ratios. Particularly so when you consider the fact that in the 1990s, the traditional limit on this thing was 36%. So it seems likely that many, if not most, of the loans being issued over the boom period under automated underwriting would have been completely impermissible under the old system. And from my past work, I would argue that these big relaxations of this limit can have a huge effect on house prices, because when they're relaxed, what the lenders effectively are telling you is that you can get a bigger loan, but because you also have a loan-to-value limit, basically you have to collateralize the bigger loan, you actually have to go for a larger or more expensive house to provide collateral for that bigger loan, which can lead these limits to have a huge effect on housing demand. So overall, I find the idea that the effect is really big plausible. In terms of the exact number, we can also compare to structural models. So for example, in work with Adam Gurin, I found that loosening credit standards in a way very similar to what's documented by this paper explains about 1/3 of the rise in house prices over the boom period. Falling interest rates explain an additional 1/3, and the remaining 1/3 is basically a residual that we believe reflects expectations. So I think this provides kind of an important caveat for the results, which is that the author's headline number of 44 to 77% might be a bit large for this direct effect that we found was 1/3. But the authors point out that this initial increase could have triggered through adaptive expectations, potentially the remaining 1/3 that we treat as a residual. So if you believe that's the case, and I think the authors have a reasonable argument that it is, and you put 1/3 and 1/3 together, you get about 2/3, which the authors are finding, and that seems about right to me. And if they wanted to, I think the authors could also potentially decompose their structural model effects into these direct and indirect sources and see if they line up with this 1/3, 1/3 breakdown. So last, let me close with some policy implications. So one thing you may be wondering at this point is, why do these automated underwriting systems allow such insanely high payments income ratios? And my understanding is that these systems are essentially using the fitted value from a default regression to make underwriting decisions. And an important and interesting pattern, the best evidence for which I think comes from Stephanie's other work, is that high payments income ratios are actually not a good predictor of default in the cross-section. The reason is that households mostly default when the property's underwater and they receive a large shock like unemployment or divorce. And basically, what matters is whether or not you become unemployed, not what your income was while you were employed. So this paper is actually showing that this statistically informed approach is ignoring a very important externality, right? These payments income ratios are not important for default in partial equilibrium, holding house prices fixed. But in GE, loosening these ratios appears to have caused a huge boom in house prices that left many households underwater after the crash, and probably indirectly caused a huge number of defaults, which is demonstrating the importance of thinking about GE price effects for macroprudential policy. So let me wrap up here. I think this is a highly compelling paper showing that this technology relaxing credit standards had a really big effect on lending and house prices. I think it's a great identification scheme comparing the two technologies, and their back of the envelope that the most of the rise in house prices explained by these technologies seems plausible to me. I think there are some important lessons for macroprudential policy, in particular that variables that are poor predictors of default in the cross-section like payments income ratios can still indirectly drive default through house prices, which will be very important for policymakers to think about going forward. So thanks very much, and sorry again I can't be there in person.